that is eligible for this program that is looking to locate in Lebanon County, and I'll let her talk a little more about the details on that. So today we had intended to do an action today. Learned yesterday that there's one more step in the process, which is a notification letter that needs to go to the municipalities about the program. We will get that done here in the next week or two and bring it back to you for action on the 21st, which is still plenty of time because I think this project they're hoping to close financing by the end of the year. So brought Holly in anyway, and she'll make the other introduction and an opportunity maybe to flesh out the project a little bit more. You probably have more information than you did back in September. Gave you each a packet that Holly provided, and I'll let her take it from there if it's all right with you.
The floor is yours.
Thank you. I'd like to introduce Don Coslo. He's the president of the Sustainable Energy Fund, and anticipating the vote, John wanted to join us today to kind of chime in and answer any questions you may still have. I appreciate the time again. I know we talked quite a bit about the program, about the Property Assessed Clean Energy program back in September, and we were anticipating a vote today, but as Jamie mentioned, we'll wait till later this month. We're really excited because as we go around the state and talk to various counties about CPACE and about this financing option, we're getting really great reception. We just had another county adopt last week out in Lawrence County on the western end of the state. And similarly in Lawrence County, there are 2 property owners who want to use the program already. And so that helped motivate the county to kind of see the benefit and take action. Similarly here, we have the Holiday Inn Express that's proposed for Jonestown out on Route 72. And that is an 81-bed brand new hotel. The total project cost is $11 million, actually $11.4 million. And they're looking to finance $1.2 million through the Property Assessed Clean Energy program. Basically what the loan would do is help pay for all those energy efficiency and water efficiency upgrades the hotel will have. Don't know if you want to talk a little bit about the program at all, or?
Sure. CPACE was passed by Governor Wolf 2018, and we put together a stakeholder group with Philadelphia and Pittsburgh, along with the Keystone Energy Efficiency Alliance, because when the state passed the legislation, they provided enabling legislation, but they didn't provide any funding or mechanism or department or anything to move the program forward. As a nonprofit that's been doing energy work for over 20 years, specifically energy lending in the state of Pennsylvania, we saw the value component of CPACE and the amount of projects that it could bring. Nationally, the program at this point has financed $1.1 billion in energy efficiency, renewable energy, and water efficiency projects. We led this stakeholder group of 138 stakeholders from across the state to develop a set of guidelines. The guidelines went out for public comment, and then the guidelines were revised based on the public comment and issued last May at the County Commissioners Association meeting in Harrisburg. Since then, Holly's been traveling around the state. She didn't know that when we hired her, but she's been traveling around the state as our Director of Special Projects, along with Julian Boggs from Kia, and talking with various counties about how to enact enabling resolutions to move forward on CPACE. We are a CPACE program administrator. What that does is we use the infrastructure we already have that was built out of the deregulation settlement. So back in 1999, during deregulation 20 years ago, we were created by a settlement at the Public Utility Commission. We're regulated by the Public Utility Commission. We turn in our annual reports, our audits to them. They also have a member of the Public Utility Commission that comes to all of our board meetings. All of our board members are nominated by our internal board, but then approved by the Public Utility Commission. So there's a very strong relationship there. The commission saw that this was a valuable tool to move project financing forward. It's actually taking off quicker than most people expected. In most states, it takes about 3 years before you see any sizable deal flow. They're forecasting $60 million in Pennsylvania over the first 3 years of the program, approximately $30 million of that in Philadelphia. But from the deal flow we've seen already, we're expecting to eclipse that $60 million mark within year 2 of the program.
And actually, I'll be honest with you, right now, I just heard that Philadelphia has a project that's in the works, and so the program administrator in Philadelphia, they have their own program, and I are kind of in a race on who can get the first project actually done in Pennsylvania, and so I'm really hoping that will be your project.
So not the first county necessarily to enact it, but possibly the first project in the
to
state.
use it. Yeah, which would be really great.
Could you, one of you, walk through the mechanics of the financing and how it works through the assessment and how it gets paid back?
Sure. There's a pre-application process. During the pre-application process, the capital provider, the contractor, and the property owner submit a short pre-application. At that point, we start looking at stuff that's required under the statute. We start looking at the amount of energy savings, the baseline, the amount of water savings in the project, or if it's a renewable energy project, the amount of renewable energy generation. We also check to make sure they don't have any liens or past due taxes or building permits open with the county. That's one of the requirements of the statute. So we work with the contractors and the capital providers to help them assemble the project and put it through the process. Then there's a final application that goes through and dots all the I's and crosses all the T's. There's a statement of levy and lien, which is an agreement between the county, the capital provider, and the property owner. In that agreement, it lays out what the assessment is in total, what it is per year. It lays out all of the fees that are associated with the project. In Pennsylvania, we're the only state that requires public disclosure for the project. Most states just require the value of the assessment, but in Pennsylvania, the interest rate and all the fees associated with the project are also disclosed. And then SEF provides a roll to the county tax department each year for collection of the CPACE assessment. It's collected through the normal property tax billing and collection process. And then after those monies are received, we distribute the monies to the various capital providers. The counties are able to deal with us as a single entity versus dealing with 5 or 10 capital providers depending on how many projects they have. We consolidate that activity. And then they go through and make the payments, and when the payments are done, the lien on the property is released, and they go forward.
I have several questions, if you don't mind. Everything I'm hearing is about the program, and I only have one page on the specific application, and it gives me absolutely no detail about what energy savings are being proposed for this particular project, nor the projections of the amount of those savings. I don't know if they're looking at solar panels. You have a whole list in this nice booklet, but I have nothing specific to this project. So that's question number one. I'm looking for specifics. Number two, does it also say there are no appeals allowed during the process of, I don't know, payback? Whatever you have. In other words, are we going to have these people get some kind of a tax break or I don't even know what all, but can they come in and do an appeal of their assessment during the period? And then the third question I have is, does the county get reimbursed in any way because of all this additional paperwork for our assessment office?
I'll start with the last question and work my way forward.
Okay.
And have Holly answer the last question since she's much more familiar with the individual project than I am. Yes, under the statute, the county gets reimbursed for its expenses. It can't charge more than what its expenses are to actually bill and collect the tax. But the county does get reimbursed for that, and there's a mechanism in the program guidelines to compensate the county.
And how is that determined? By a percentage? By, do we have to take the individuals that's working on it, their salary, and?
It depends on how the county decides that it's in their best interest to calculate
You would
what that
determine
dollar
that.
value is.
Yeah, you would determine that based on staff activity and costs, and then let us know. Some counties aren't, because it's gonna be such a low volume, maybe one project a year, some counties aren't even going through that process of coming up with an administrative fee, but it's definitely something in the statute that you can do, and so you would just tell us what that fee is, what that cost is annually per project. Yep.
The second question. I forgot.
Appeals during.
Appeals. No, actually, because it is a tri-party agreement between the county, the property owner, and the capital provider, there's no appeal for the assessment. The assessment does not accelerate, so the assessment follows the property through different owners, and since it doesn't accelerate, it means if they default on that assessment, then the whole loan does not become due. It's not like a mortgage through a bank where the whole loan becomes due if you default. It's only the assessment for that year. And that's there to protect the local banking industry. So if they foreclose on a property, they only have that one assessment to deal with. They don't have an acceleration of, in this case, would be $1.2 million.
Let me see if I can clarify. I'm not sure that's the context of the question. So when this is built, the county will put a property assessment on it, $10 million or whatever the property's worth, which is then the basis for the taxation, property taxes. And any property owner in the county can, in any given year, appeal their assessment saying, I don't think it's worth that, it should be lower. It sounds like you were referring to the amount that's being financed, but what about the overall value? This actually isn't based on their assessment, it's only based on the financing, but is there any provision that during the period of their participation in this program that the county's assessed value is locked in?
Oh, I misunderstood the question, yeah.
I thought so, the way you were answering it.
This is an issue with the way the statute was written. It uses the term assessment to mean that annual payment. And at the same time, most counties use the word assessment as the value of the property and the assessed millage for that property. It does not impact the assessment from a traditional perspective at all.
So there isn't a lock-in or anything.
No.
It's silent on that, and the value of the property, the assessed value of the property, I don't think is really material to the amount of the financing. I mean, it's as long as they're making the payments with the tax bill, whatever that tax bill might be. So there are some instances where, like a LERTA program, for example, where the assessed value is locked in. But that's because the assessed value is on a stepped up increase over typically 10 years. So obviously it would be a disadvantage to the taxing bodies if that were to lower midstream. But so anyway, I think that was the question.
Actually, the one thing it could do is if you have a significant gut rehab, which these projects are great for that would, as building permits are pulled, that may trigger a reassessment and an increase in value of the property, which may in turn lead to increase. I mean, it's like any economic development tool, as it enhances the investment in the building, that it enhances the value of the building. But it's not tied to it. That annual payment for this loan is separate from your property tax assessment process.
And how about our credit rating? Is it impacted in any way?
No, this is all done through private capital. So it doesn't impact the county one bit.
It's private equity being invested in private property, but using your collection process. The county's not obligated in any financial way.
Okay,
To
then
those
the
loans.
final is the specifics of the particular project you're inquiring about.
Yeah, so two things on that. One is the program guidelines is about a 65-page document, which I probably should have brought you hard copies, I apologize. That kind of lay out what the expectations are of the county, and all counties are going to use the same guidelines, we're hoping, of what the energy savings is, what does water savings look like, what are these technical measures that the project must meet. Those guidelines, once adopted, are what the project has to meet. So a 20% energy savings or significant gut rehab, things like that. This project, they haven't given me their energy survey yet. They haven't done the application. They've done the pre-application, but they haven't done the application. So I can't tell you specifically what their anticipated energy savings is. Quite honestly, we may get to the application phase and it might not meet your guidelines, in which case we wouldn't recommend it for approval. So it's in early stages in some ways with this project.
And what we have in Lebanon County right now is kind of a parallel process. It's the program being considered at almost the same time that the first project's being considered.
Mm-hmm.
The other counties, you've enacted the program,
Right.
but waiting for someone to apply.
Yeah. that's
So this one may be two-part. It'll be the program, and then the application will come along. But it sounds like they're going to be really close together.
true. Yeah.
Yeah, with the exception of Pittsburgh and Allegheny County, there's only 3 projects outside of there that are on our radar at this time.
Okay.
2 in Lawrence County and then the project in this county. But as far as Wayne County, Northampton County, Chester County, they don't have projects yet. There's one that's developing in Montgomery County, and they're going through a parallel process right now.
So if I could expand on that question a little bit. So the application has to be approved separately by the county from the program. So each time, say 2 years down the road, another project comes along, that comes before the county?
No, you would
Once
approve
the
those program guidelines, say this is the standard we want projects to meet, and then we would
And then you,
verify that they
okay,
meet.
then you verify it, okay.
So we will never know what they're actually saving, we won't get an account.
Oh,
No,
yeah.
we submit to the county a form that lists how much energy they're saving, what they're doing, as far as do they have any tax liens on that property or other properties within the county. There's a lot of information that's submitted to the county. I don't know your exact structure. I don't know whether you have a county executive or a county clerk or
It's
administrator.
I'm the clerk, then this is the governing committee.
But it's generally handled by that person. In Wayne County, it's handled by the county clerk.
Vicky Botcher?
Yes.
Yes. Mhm.
And she receives the information and then distributes the information throughout the county.
Okay.
Any other questions? Any questions?
Yes, I do. I think I'm missing something. I'm not sure why the county is in this. You have a loan program that if this Holiday Inn Express says, it's gonna cost $11 million to build, and you're saying we'll loan you $1.1 million if you follow these energy guidelines.
Mhm.
So how does the county get it? Because they'll assess the property if you're there or not.
Yeah, so,
Yeah, with property assessed clean energy financing, what it allows for is low interest, longer term loans. In a typical environment where you have a hotel, for example, a traditional bank may only loan that hotel 65 to 70% of the value of the project. And then the owner of the hotel has to come up with that 30% in equity or some other type of financing.
Okay.
By utilizing this, they reduce their equity position in the hotel, and they pick up additional financing. Traditionally, this financing is not done by a bank. Most banks will finance for 5 years or 7 years at a fixed rate, and then they have an index after that first 5 or 7 years where they adjust the rate for longer term loans. It's unlike a residential mortgage where they lock in for 25 or 30 years. There is something called an interest rate swap, which is a little bit more technically complicated. but that can lock in interest rates for 15 years, but there's some risk with that. If there's an early repayment, there's no risk in the CPACE program from early repayment. The property owner could repay the assessment in 2 years, and there's no penalty for them doing that.
What are you asking the county for?
The county administers the program. We act as a program administrator and take the load off the county at no cost to the county. But the county actually does the billing and collection of the special assessment of the payment, the annual payment.
So they add the payment amount to someone's property tax bill. Someone the property owner volunteer for this program, know the loan's in place, and then the county does the billing on the tax bill. What that does is the lenders are then comfortable lending for 10, 20 years, which is often tied to the life of the equipment. So, you know, a big expensive boiler can be paid off over the life of that big expensive boiler, rather than trying to pay it off in 5 years, like through a bank loan. So the county's using the county collection process. It allows the property owner to get a longer term loan at a good rate.
So
It is
what
very
happened-
active in 20 other states. The program's adopted in 35 states, but it's very active in about 20 states, and has helped a lot of properties.
So what happens if the boiler doesn't last the life of the loan?
The property owner takes that up with the manufacturer of the boiler. It's like under warranty for 20
No, they'll
years.
have to replace it, and it's not going to be under warranty that long. I've owned and operated an auto body shop for several decades in the past, and boilers just don't last that long. So, do they get a second discount, or what happens?
We're not involved in
That's
that,
all
right?
negotiated with the lender and, property owner and lender, which is why the program's just for commercial property owners, not for residential.
Actually, through the guidelines, the average life is established. So let's say they had 5 measures they're doing some water efficiency measures, they're doing a boiler, they're doing a chiller, they're doing some LED lighting and some insulation in the building. It looks at the weighted average cost of all those measures and the life of each measure and comes up. So if it's an LED lighting retrofit, for example, the life expectancy of LED lights is approximately 10 years in a commercial office setting. So the loan could not, by the guidelines, exceed a 10-year window. If the life expectancy of the boiler is 12 years, then the loan cannot exceed the life expectancy of the boiler.
So the longest life expectancy is what determines the length of the loan?
No, it's a weighted average. So let's say the boiler costs $100,000, the insulation costs $25,000, and the lighting costs $40,000. You would take the different life cycles of each one of those and weight those by cost to determine what the lifespan is of the project.
Sounds very complicated.
Okay, anything else?
So if you have any of the other information to fill in on those agreements, if you get
Yes,
interest rates,
yep.
let me know,
Absolutely.
we'll fill them in and have all that stuff ready.
Okay, very good. Thank
Thank you,
you.
Holly. Thank you.
Thank you.
All right.
Good to meet you, thank you.